Hey guys, welcome back to the Xplor Show. Today, we're thrilled to host Michael Huseby, a distinguished attorney at DLA Piper and a Twitter sensation known as the investment lawyer. He's renowned for his experience and expertise in forming and operating funds. Michael brings a wealth of knowledge in venture capital, real estate, crypto, and private equity. Michael, welcome to the show, bud.
Thanks, man. That's quite the intro.
Well, we get on, we did a little bit of research and thankfully put this together. We met Michael about 6-7 months ago on Twitter, I think.
Yeah, long time. Yeah.
Actually, it would have been longer than that because you were my number one cheerleader when it came to doing
Your
the
race.
Ironman back in May.
That's right. All of your 3 and 4 meter runs.
Oh, hey, a lot of running to get prepared for one of those, right?
That's right.
Well, Michael, tell us a little bit about yourself. So, obviously, you're an attorney and you absolutely crush it on Twitter, which is why I wanted to bring you on here. Wanted to talk a little bit about fund structures. It seems to be kind of the popular thing to do today. Everybody is interested in raising capital, private equity, going and starting syndications and getting into real estate, it seems like. So, tell us a little bit about your background and what got you into syndications and putting together funds, and we'll get more into detail there.
Cool. Yeah, man. So like you said, I form investment funds. That's basically what I do all day, every day. As far as why I got into investment funds, I used to do like all sorts of corporate lawyer stuff, like M&A, capital markets, blah, 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 blah. At one point, I bought some rental properties and I thought, hey, this is kind of fun. I like real estate investing. And I've always been interested in investing generally, but it was really fun buying these rental properties. And I thought, hey, I kind of want to help other people do this too. And so I used to work at a firm called Latham and Watkins, and I knew a guy there who had done a lot of fund formation. And when I came back to the law, I took a break from law, lived abroad, long story. But when I came back to the law, I reached out to this guy. I was like, hey, can I do fund formation with you? And he said yes. So that's what I've been doing for the last several years, and I love it.
So, how has your your real estate investment journey gone so far? So, if I remember right, you bought a couple of single family homes to
Yeah,
start.
that's right. And the duplex, it's been a mixed bag, certainly. The first house I bought was it's like $60,000. And it was,
Oh, it was a beauty, wasn't
it
it?
was, yeah, it's still a beauty. I will say that it's been a bit of it's been an education project. It's one of those things where I've learned a lot of stuff not to do, a lot of stuff that went well, but a lot of stuff that went not well. Luckily, I bought it in 2020, so the inflation kind of washes away all mistakes,
Yeah.
which is nice.
Where was your first property
Uh,
location wise?
Clarksville, Tennessee.
Okay. Is that
It's
south of
like
Nashville?
it's like 45 minutes northwest.
Northwest. Okay.
Yeah,
Very nice. Is
yeah.
that a travel location or what brought you to Clarksville, Tennessee?
It just happened to be a place that I found that had good rent to price ratios, good population growth, that sort of thing.
Yeah, I mean, all of that area around Nashville has just absolutely taken off, especially since 2020. I can only imagine the appreciation you've received on that place.
Yeah, pretty good. Pretty
Do
good.
you keep it pretty well leased up, or is it short term, long term? What's that look like?
It's long-term lease. It's been leased the whole time. I'm on my
Okay.
second tenant now, but yeah, the demand's pretty good out there. There's a military base close by as well. I haven't actually had any military people in it yet, but there's still, there's kind of recurring demand.
Okay, nice. And then what other properties do you have?
So the next one I bought was a duplex in Chattanooga, also Tennessee. So that's actually been going much better, much more smooth, and that's been
So
good.
you like the mountains.
I do like the mountains. Yeah, I live out in the mountains now, which is nice. Problem is the rent to price ratio out in like the Seattle area is trash. Like you can't, it's going to be like probably 30 years before I can rent my own house out for like at par, or not at par, but like to break even.
I don't know how people afford to do it. I don't know how you can invest out there and make any money. It's absolutely crazy to me.
Yeah, I know. That's why everyone needs to move to Kansas City.
That's right.
It'll be a lot
Hey,
better.
please do bring the prices up. I would love that, right?
Yeah, yeah, man.
Let's get back to the beginning here and talk about setting up funds. So
Yeah,
when you're let's particularly talk about real estate because that's obviously what both of
yep.
us do here right now. And what are the key considerations to setting up a fund, a real estate fund? What are things that
Yeah.
people the first couple of things that people need to think about and know when they're coming to do such thing?
Yeah. So one of the first things is, do you want to raise a fund at all, or would you rather do deal by deal? So that's kind of, that's one of the more common questions I get. So, if you're doing apartments, like for example, if you're doing single family homes, you're not going to do deal by deal. That would be silly. But if you're doing something like apartment buildings or strip malls or whatever, there's a valid question as to whether you want to raise $5 million each time, for example, or whether you just want to raise a $50 million fund to do 10 deals. And there's various pros and cons. If you're just starting out, it might be harder to raise a fund because people might be a bit more hesitant to say, oh, like here's $50 million for you to go off and buy whatever you want. So
That'd be
usually
nice.
it would be nice. Yeah. I mean, that happens. It happens. Like it definitely happens. But usually they're going to want to see some sort of track record first. And the track record often comes from doing deals in a by deal format because these can look at the deal. They're like, oh, this development project, like it looks good. I like it. It makes sense to me. I can see it. I know where it's going to be. They might be more likely to invest. You might get some of those under your belt, and then you go try to raise a fund. If you can raise it, go ahead.
I was just gonna say, so what's the most common, I guess, that you see or you work with?
I mean, it's all over the place. Kind
Okay.
of all these funds, like there's a humongous range. I mean, we have people raising funds with a couple $1 million, and we have people raising funds for $1 billion. So
What's
it
the
all kind of
threshold
depends.
where it makes sense to
Yeah,
bring somebody like yourself in and say, hey, Michael, I want you to represent me. I want you to structure everything. What's that threshold where you say, okay, it's probably worth your time, our time. Let's go ahead and do this and go.
yeah. I would say for a fund, the minimum is probably around $5 million, or potentially a bit less. But
Because you're going to
somewhere,
have those costs with you guys and everything that adds up. So if it's under 5 million, it's like, yeah, you might be better off going another path. Is that what you're saying
yeah,
essentially?
that's right. There's certain costs that are somewhat fixed, like the lawyer setting it up, like fund administration. Excuse me, administration. Those are the accountants who do the back office sort of stuff. CPAs, various types of software, like if you're going to use Outfolio or Juniper or whatever. Those pretty much all of those do have some sort of sliding scale element, but there is, some sort of fixed cost such that you don't want to be paying like 10% of your fund size on like lawyers and accountants and software. That's a massive
Yeah,
drag.
your LPs wouldn't be very happy about that.
No, so it's really a business decision about how much money you have, because the fund pays for all this stuff. So you want to make sure that you have enough money to make it worth it.
So, okay, what are the most common pitfalls that you see with clients that uh, are starting to raise a fund, I guess, and
Yeah.
how can they be avoided up front and maybe save some money and not make these errors?
Yeah. So the first one is an admittedly self-serving comment, but a solid contingent of my clients are people that tried to raise a fund before, or raised a fund one before, using just like a standard like neighborhood corporate lawyer.
Mm.
And that is often a disaster. So I would not do that. You don't need to use a firm as big as DLA Piper, but use someone who actually does funds. Because otherwise, like I've seen things like people forgetting to put the waterfall in the LPA, which is the whole point of the LPA.
That's a big deal.
That's a big deal. Um, so yes, and people like don't know that there are regulations that apply to funds, so they just like don't think about that, and they're not compliant with them, and then you have to like spend all this time digging them out of the hole. So I would say, and it's not just lawyers either. I mean, it's like build a team of professionals, because like you are a steward of other people's capital, and if you screw up, like it's a lot worse than screwing up with your own money. Because then people get grumpy, they can sue you, or even if they don't sue you, they can just call you and complain every day, and that's no fun.
Oh no, that would be awful. How would you sleep at night if you had people
yeah,
constantly calling you,
yeah,
asking where their money is? There's nothing worse than owing somebody money, in my opinion. And when
yeah,
you don't have the funds to pay them back because a project went bad, you better hit it, make the communication up front and just spearhead it, because if you don't, it only gets worse and worse and you dig yourself in a hole, in my opinion. A lot
yeah,
of people will be understanding if you are very communicative with them, but if you're not, oof, good luck.
yeah. I mean, that's honestly, that's my second piece of advice. So I mean, I totally agree. So much is just communication. Uh,
Yeah.
because
People
I
are
know,
understanding. People
yeah,
understand things. Things do happen. But if you try to hide it or backdoor them and tell them things are great and really they're not, and then it's going to come out at some point, so you might as well tell them right away.
yeah, no, totally. I mean, it's really it's bizarre. I mean, you hear these stories of like GPs that just don't respond to emails and don't send out updates for like a year, and then they just like I don't know. It's really bizarre
And
to
now
me.
they're calling because they need capital.
Yeah, yeah. Good luck with that. So yeah, communication is very key. Um, and yeah, I mean, some of the big considerations up front are mostly tax and regulatory related.
Yeah.
If you're like with real estate specifically, if you it really depends on who your investors are. If you have just US people, like us investing, humans, then it's not so hard.
Are
If
you
you start
saying people outside of the US are not humans?
no, I will explain. I will say I am married to people outside the US, so I think very highly of them. Um, what I mean is this, Scott. If you are a non-human in the US, such as a pension or a university or some sort of tax exempt organization, then it's harder to accommodate you than just a human in the US.
Yeah.
And same with humans and non-humans alike outside of the United States. It's for a different reason, but it's basically the same general idea that they don't like getting basically real estate income directly. So you have to like do some fancy structuring. You set up some like things taxed as corporations, which are called blockers, to block the bad income, essentially. So that
So you
stuff,
kind of need to know who you're going to be raising money from. Not all the way who exactly it's going to be, but if you are planning on going and trying to get these organizations to give you money and funds, these pension funds or
yeah.
universities, whatever, you kind of need to know that up front when you're structuring these things, or else it might cost you some more if you change paths down the road.
Yeah, yeah, absolutely. Or you end up with really mad investors because they don't know. I mean, the
Yep.
big institutions, they know. Like that's going to be in their side letter request 10 out of 10 times. It's going to be like block the bad income. But if you just, you have a friend who just like lives in Spain or something. I don't know the tax treaty with Spain specifically. Each country has a different tax treaty with the United States. But if you have someone else, and then someone outside the United States, and now they like surprisingly have a requirement to file a U.S. tax return and pay U.S. taxes, they're not going to
Mm,
be very happy with you.
mm.
So
Yeah, they'll
you
probably be
want,
pissed.
yeah, they're going to be pissed.
That's not good. Okay, so we want to set up a fund. First, we need to figure out how much we're going to raise.
Yeah.
Okay. Second, we need to decide, okay, what attorney or what firm are we going to work with?
Yep.
From there, we go to the attorney, the firm would come to you, Michael, and say, Michael, all right, we're going to raise $10 million. What do we need to do next? Do we
Yeah.
need to
So
decide 506B, 506C? What's kind of the next step there?
yeah, look at you. You could be a lawyer.
You've taught me
So,
well, my friend.
so so 506B versus 506C is important. So I'll get to that in 1 second. The thing just before that is, deciding what the terms of the fund are. So
Let's talk about that first, actually, because I do
yeah,
want to know. Obviously, it's whatever the GPs and people decide and agree on, but in
yeah,
general, what do you see are the most common um, breakdowns for
yeah.
payouts and preps right now?
Most common is a 2% management fee, which is based on committed capital during the first part of the fund's life, and based on invested capital, the second part of the fund's life. And then an 8% preferred return. After that, profits are split 80/20. So it's been the same for a long time. And on the
And when you say
margins,
80
yeah,
20, you're saying 80% to your LPs,
that's right.
20% to your GP.
That's
GP
right.
being general partner, LP being limited partners, for those that
Yeah,
might not know.
very good. Yeah, that's
Okay.
exactly right. And you
So
can you
eighty
can get
20
creative.
split.
Yeah, yeah.
And then I guess, do you see waterfalls a lot of the time on those type of splits as well? Once they hit a certain number, or no?
So, like, at least in my world, what I just described is a waterfall. Just so, like, when people hear, like, what's a waterfall in general is just like, how does the money go out? So I think
Yep.
what you're referring to is like some sort of complex waterfall with lots of
Yeah,
different
once you hit
tiers.
20% return, once
Yeah,
LPs get
right.
20%, then we split it 50-50. Some people get really,
Yep.
in my opinion, overly complicated
I
with these
agree.
things.
I agree. But yes, we have clients who do that. We often like I often try to convince people, like, let's try to be middle of the road. Let's not try to differentiate based on fee
Yeah.
structures. Um, because it's going to take more work from me. It's going to take more work from your accountants. It's just a lot more
Oh,
work.
ton more tracking. People
Yeah.
question. You're going to get questions a lot more because they're going to say, well, hang on, why are you getting this much more now? And I can
Yeah.
imagine how much that. All right. So 80-20 is pretty normal after an 8 pref.
That's right. And in real estate and private equity, you might have more tiers, like you mentioned, based on IRR. So you could say, after 12% IRR, it's 70/30. After 18%, it's 50/50, whatever you want. In venture, the extra hurdles are usually based on equity multiple. So like it's 80/20 until you hit like 3x, and then it's 70/30.
Yeah, that gets way too complicated. Those guys try to get so creative and make every penny. It's nuts to me. So we're not even going to get into that on this podcast because we could talk all day on different structures. So will you explain real quick to somebody that doesn't know?
Yeah.
I mean, a year and a half ago, I had no clue what any of this language meant. So I
Yeah.
know where some people might come from. When you say
Yep.
an 8 pref and then a waterfall, explain what that means.
Yep. So the easiest example is pretend that someone puts in $100, and then a year later the fund doubled the money and there's $200. So the question is, like, where does that $200 go? So in pretty much all fund agreements, or not, just a lot, the first step is the LPs get their money back. So $100 went in, you have $200. The first $100 goes back to the LPs. That's step one. Step two, which is not always in funds, but is often in funds, especially real estate and private equity funds, is the next step is, in addition to getting their money back, the LPs get some sort of preferred return.
Which is
And preferred,
pref.
yeah,
Is
pref,
what we call it,
exactly,
pref.
exactly. And a common preferred return is 8%, annually. So if it takes 1 year to return the money like this, that's a nice easy $8. So the first $100 goes back to the LP for the return of capital step. Then there's the preferred return step. Another $8 goes straight to the LPs. Then you have $92 left. That is what gets split 80% to the LP and 20% to the GP. So
That's
as you
your
see,
waterfall.
that's, yeah. Well, the whole thing is the waterfall. At
Yeah.
least the way that I speak about it. Like, all three steps are the waterfall. Um, but so you'll see, like, the vast majority of the money goes to the LPs. The GPs get like a 20% after a lot of the money's gone back to the LPs. There's, like you said, there's a ton of ways you can make this complicated. But that's kind of the simplest version. In venture, there's usually no preferred return. So that's kind of the distinction. It's usually just give the money back and then 80/20.
Interesting. I did not know that. Okay.
Yeah.
Huh. That's unique. Why is that? Because they aren't necessarily cash flowing on those like you can in real estate?
Yeah, I mean, it's kind of just what the market is.
Hmm.
But yeah, I think part of it's like, the point of venture is to get just big wins. You're not really like in your head, it's not like, oh, I'm gonna like get 8% return from venture. It's like,
Yeah.
either we're gonna make a ton of money or it's all down the drain.
1 in 100 hit and it pays off the whole
Yep,
portfolio essentially.
that's right. That's
That's
right.
awesome. Okay. All right. So that makes sense. So now let's go to the next step. So we figured out the structure, how we're going to pay people out. What do we need to decide next?
Yeah. So next, you touched on this. It's important to know, how are you going to go raise money? Because after you have the summary of terms, which your law firm will help you prepare, you go out and take that and start to raise some money. But like, where can you raise the money? It's an important question. So in the past, until about 10 years ago, the only way you could do it privately, and privately means like not filing an IPO with the SEC, which would be outrageously expensive.
Yeah. Don't do
Is you had
that.
to you had don't yeah, definitely don't do that unless you're like Blackstone or something. And if you're Blackstone, I'm sure you're listening to me on this podcast right now.
That's right.
Sup, Steve? How's it going? um, but uh, the old way is called, 506B, which is a private placement. 506B quiet is what I call it, just so you can remember. Like, no going on podcasts, no talking about stuff like that, no posting on Twitter that you're raising money, nothing of the sort. The other version, which was invented a little over 10 years ago, is called 506C. And 506C means you can speak publicly. You can go on podcasts, Twitter, advertisements, whatever you want. The difference is you have to prove that all of your investors are accredited. So it's a bit of a bar. It's not that hard. You just have them fill out. The way we typically do it is we give clients a letter that they just have their CPA, accountant,
Mhm.
lawyer sign that says, yeah, they're accredited. And then you're good. There are also online services that will do this for you for relatively low cost, like $25, $30. Um, and then you kind of had a bit more peace of mind, in my opinion. If you're 506B, be quiet. Like, you have to be like, what can we say? And the problem is, like, we don't have a list. There's not like a
Yeah.
list that the SEC puts out that says, like, on this side are things you can't say. On this side are things you can say. It's kind of just like, well, don't talk about fundraising and be careful. Whereas 506C, as long as you're, being honest and not misleading, you can say generally whatever you want. Like, one aside on that is I've seen a lot of crazy stuff on Twitter recently, which even if they are 506C, it's like, it's nuts. They say stuff like, oh, this fund has a guaranteed 16% return. Like,
Can't
no,
guarantee that.
there's no guaranteed 16% return. What do you mean? So that's the sort of thing where, like, if an investor does not get a 16% return, that's a slam dunk lawsuit.
Yeah, you're in trouble.
A slam dunk. So don't do that. And don't be too, like, optimistic with your projections either. Like, don't say you're going to get a 27% IRR base case. You'll look very silly, first of all, and investors won't believe you.
Yeah.
Um, and if they do, they're probably not very sophisticated investors, and you're going to have some problems on your hands, when the chickens come home to roost.
Yeah, and picking the 506C versus 506B, in my opinion, is probably a little more just again, in my opinion, more responsible because you are just verifying these people are accredited. You know where the funds are coming from. I mean, you might not know exactly where they're coming from, but their attorneys or lawyers saying, "Hey, they're good to go." So then you hopefully aren't going to have, if things do go weird or times get tough, you aren't going to have all these in a 506B. You might have a bunch of friends or people putting in small amounts of money. Well, they might need that back a lot faster. Hopefully, with the accredited investors, you aren't going to have that as much because you are verifying, hey, you have a certain net worth or you make a certain amount of income. Little more stable, maybe in that scenario. And that's just my thoughts on it. I think
Yeah,
506C makes the most sense personally.
yeah, and you
Just
bring up a
protects
good
you as well.
yeah, you bring up a good point about raising money Like even if someone is an accredited investor, let's say your minimum is $100,000 and like their liquid net worth is $200,000, like you don't want that as an investor.
No,
Like you don't want to take money from someone who whose life will be devastated if you lose it. Because they're
yeah.
going to be on the phone with you every day because it's like half of their net worth, you know. So you don't want to take checks like that, in my
Especially
opinion.
right now when they're hearing the news say all these negative things about commercial real estate or blah blah
Yeah.
blah. I could only imagine the calls that some of these GPs are getting, and a lot of them deserve. I mean, they need to be getting called because there's a lot of deals that are going south and haven't been well the last couple of months, and hopefully people figure it out. But
Yeah.
yeah,
Yeah.
you want to make sure people are understand real estate investing. Honestly, if all you have is $100,000 or $200,000 liquidity in cash, like it's probably not the smartest thing to be getting into these syndications or these funds in real estate. I mean, there's a lot of other things you can do, a lot safer things you can do out there, and you can
Yeah.
kind of do them yourself even. So
I agree. I agree totally.
so I pick 506B, 506C. Next step is let's get this paperwork drafted and start raising capital, right?
Yeah. Yeah. I mean, so you can actually typically our clients go start raising capital before we get the documents drafted. The summary of terms, at least that we prepare, is like 15 pages long. So it's decently built out. Like you know what the terms are. So usually what happens is it's kind of like a de-risking maneuver. We have the clients go out with this, and then we see like, can you actually raise a fund? And then if not, then like, okay, like you only spent, I don't know, like $5,000 on the initial portion of the project, and then you're done. And I was
Got it.
like, well, that wasn't great, but you'll be okay. It's only once the like it looks like there's going to be some sort of closing. Like there's investors, they want the documents. Then we go form all the entities, draft all the documents, that sort of thing.
Got it.
Um, and it's just like I said, it's a de-risking sort of arrangement. And then you send the investors the documents, and then if they're happy, they sign them. If they are interested but want some changes, then you might change the LPA or do one of those side letters we talked about. And then eventually the LPs send back signed documents. And then when you're ready to hold a closing, the GP just countersigns all the documents at once, and it's the closing. Everyone's happy. And then at that point, you can start calling capital to make investments. And like one nuance here is in funds, you typically have like 12 or 18 months after that first closing. In closed end funds, you typically have 12 to 18 months after that first closing to keep raising money. So you can make investments and raise money at the same time. If you have an open-ended fund, you can kind of do whatever you want and raise money forever.
And that's kind of important because you don't want to go get necessarily all that capital right away and not have the deals already lined up or ready to close on, because you're going to start owing these investors, or really they're going to start expecting returns. So you probably want to have an idea of what you're buying, but at the same time, you've got the clock ticking on these closed-ended funds. So you've got to move pretty fast. Even if you don't have the deal yet, you better go find them pretty quickly. Because like you said, you've got 12 to 18 months to get all the capital in and close it out.
Yeah. So there's one point I think we should clarify, and it's an important difference between I think deal by deal and funds. Is in a fund, so a typical fund, let's say a typical closed end fund, let's say it's 10 years long. Typically, the investment period, which is the period where the fund's making new investments, is 3 to 5 years. And so the way that the flow of funds work is at the first or at the closing, the investors sign up. And when they sign the documents, they're like, Scott, I will give you 100 I'll give you 100. Sure, why not? 100
You can
million
give me
dollars.
100 million,
I'll,
please.
I'll give you $100 million over the life of the fund. Big check. You don't actually send the $100 million immediately. That stays in the
Yeah.
investor's bank account until the GP calls that money via what's called a capital call. So usually, the it's funded in stages and tranches, and the clock for calculating things like preferred return and all that sort of stuff, IRR, it only counts on dollars that have been moved from the investor's bank account to the fund's bank
Into,
account.
yeah.
So there's not, I mean, there certainly is like a certain pressure to like do stuff because you're a fund and you want to make investments and be successful. But
Yeah.
it's not the sort of thing where like from day one, like if you have $100 million of commitment, that there's like an $8 million pref ticking every year. It only ticks on the money that's actually been called into the fund's bank account.
Perfect. I think you broke that down very clearly for people. So I can't thank you enough. Honestly, that it's very important. A lot of people are illegitimately raising funds, and there's a lot of probably securities law violations that have happened in the last several years with real estate, how crazy it's been. So I think it's important to even just have the smallest amount of understanding of what this is and what you guys do on your end, because if you are an investor, you want to make sure that you're protecting yourself if you're giving these people the capital. So it's really their responsibility, but your responsibility as well to make sure, hey, are these legal docs legit? What am I signing? What am I seeing? Because it can quickly turn upside down, I guess is what I'm trying to say, these investment deals. And we're seeing a lot of that right now. And if you didn't have these structures done right, I just gave a buddy of mine a couple $100,000. Well, it's kind of your own fault for not taking the time to understand what you were investing in and what these funds actually look like, and making sure that you are protecting your own capital.
Yeah, I mean, I agree totally.
I mean,
You
as a
have to, you
lawyer,
have,
of course you do. I
yeah,
mean, that's how you make your money, right?
yeah, that's right. Everybody needs a lawyer, and that lawyer is me.
And we
Um,
love the free advice, guys. We love
yeah,
the free
no,
advice.
no, 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 no. There's no
Oh, I
advice,
know. I'm
Scott.
getting a bill.
Nothing on this podcast is legal advice
That is,
or
yes,
investment
sorry.
advice. It's for informational purposes.
That is correct. Thank you for
Yes,
disclosing.
thank you. Yes,
My question. So, selfishly, I want to ask you this.
yeah,
All right. I've got, I've got a portfolio of houses.
yeah,
Okay. These houses are cash flowing. And my pinch is, liquidity is always kind of the thing in real estate, right? It's always a liquidity game. If I wanted to take all my properties and say, hey, you know what? I'm going to start a fund. I'm going to
yeah,
take what I've got. I already know
yeah,
what they're doing. They're already performing assets. I'm going to throw these into a fund. Okay. After that, so that's my equity in these properties is my investment into this fund. And now I'm
yeah.
going to go raise 2 million, whatever many millions of dollars on top of the equity that I put into the fund.
Hmm.
Can I do that? And how do you do that? Just
Yeah,
real quickly. You don't have to go
yeah,
super
yeah.
in depth because we're running long,
No,
but I want to kind of have
no
an idea of how.
worries. Yeah. So you can do that. I will say I'm not sure that this is a good way for you to get liquidity. I think you're still going to be illiquid. Um, because now instead of owning real estate, you're going to own interests in a real estate fund, essentially. But it is something that you can do, and it's something that's done relatively frequently. So the idea is basically you're going to raise a fund. Let's say it's $100 million fund, and you have $50 million worth of houses. So basically, like you are going to sign up as an investor in your own fund with a commitment of $50 million. But instead of putting $50 million of money in, you put $50 million of real estate in. And so now you basically own, $50 million worth of fund interests. And you can do this for sure, but you really, really need to, in my opinion, do two things. One is disclose, disclose, disclose. You want to be telling the investors, like, I'm putting real estate in, not money. Um, and going hand in hand in that, you need to be very clear about the pricing. Like, how are you valuing this real estate at $50 million? You
Mm-hmm.
you can't just, honestly, I would have the LPs approve it.
Yeah, you'll probably get
I
appraisals and everything else, I would assume. I
Right.
mean,
Yeah,
you would
you'd
want to
want to
make
get
sure that those
appraisals.
were legitimate prices.
You'd want to get appraisals. And that might be enough. I mean, it's still good to have the LPs approve, I think, or at least,
Yeah.
notify them, and let them know, because what you don't want is for you to put in this money, you got $50 million worth of credit, and then 5 years later, the LPs are like, this was a self-dealing transaction. Scott knew it was only worth 35, not 50.
Yeah, that'd be a
He
nightmare.
basically just stole from us. So you don't want that. But it is something you can certainly contribute property to the fund instead of cash. That's something
Would
you
that
can
be,
do.
would you have to, and you're not an accountant, obviously, but would that be like a 721 where you roll the property in? Is that what that is?
I'm waving the white flag
Okay, yeah,
on
that's
this one.
fine. I've just done some research. I think it's a 721 versus like a 1031 where people could contribute property to a fund versus
Yeah.
capital.
Yeah, it's
Um,
definitely not a 1031. I mean, as again, I'm not a tax lawyer. The point, I guess, of this is that should not be a taxable transaction. Contributing
yes, that's what I
the
wanted to clarify
yeah,
and
yeah,
let people know there is a way to do it and to then continue to roll up, hopefully. And see, the reason that would make sense or that I was considering it or thinking about it is because I feel like I could take the equity and continue to roll that up into bigger deals if I
yeah,
started out that way. I don't know. Just an interesting concept. And I've had a lot of other people ask me about it. You know, they've got all these properties that are cash flowing, this and that. They don't want to sell them, but they also want other opportunities. It's like, well, what if we could create a fund with what you've got?
yeah.
So, okay, there is a way. Well, Michael, before we end here, what is the number one piece of advice that you would give to a new, somebody new into the real estate investing world, private investing world? So I'm an LP. I want to invest
Yeah.
in real estate. What is the number one piece of advice you're going to tell me?
If you're an LP, I would say number one is do research on the sponsor and make sure you trust them. Because at the end of the day, you'll see a deck and there'll be numbers and there'll be graphs, there'll be all sorts of stuff, but it's all just projections. Nobody knows what's going to happen.
Yep.
So to me, it's like, if it says 17% IRR or 20% or 13%, like obviously some thought went into those numbers, but it's based on a raft of assumptions that may or may not come true. So it really comes down to like, do you think this person is going to be honest and do things in a stand-up way? Or do you think when things go south, they're going to try to like weasel extra dollars out of you? Um,
Yeah.
Another thing that I just like, it's kind of bizarre that I have to say this, but if you are buying real estate like on your own, like hold it in an LLC.
Yes.
Sometimes on Twitter, people like say, no, just have insurance. And like, it's outrageous. I can't believe that's
The
even an
personal
attorney.
liability
Yeah,
is insane when you do
it's
that.
nuts. It's nuts. Like, but use an LLC. It's
It's
very
so
simple.
cheap, so easy.
Yeah, yeah.
People
So
act
yeah,
like it's so complicated. There are so many steps. We got to have all these bank accounts and then all these returns. And when I start saying all that, I immediately know, okay, you don't know what you're talking about, or this
yeah.
conversation's over.
Yeah,
I
because
mean,
you don't want otherwise, like, theoretically, like, if someone, like, gets hurt on your property and the insurance doesn't cover it, then they're gonna take your house,
yep.
and that is not what you want.
No, a lot of liability doing it that way. And you want to make sure to protect yourself.
Totally.
So, Michael, tell us where we can find you on social media. How can people follow you and get this advice like you're giving here? No, sorry, not
No,
advice.
no, no. No, no,
Had to
no.
get you. But no, where can people follow you on social? Where can they find you?
Yeah, Twitter, the name is The Investments Lawyer. The handle is investing_law. On YouTube, I have a channel with all this sorts of stuff called The Investments Lawyer.
And he wears a
And
cowboy
then
hat all the time, and I
I only
love it.
sometimes because people yell at me when I don't wear
I
hats.
wish you would have worn it today.
I probably should. I mean, it's right over there. Yeah. So investments lawyer on YouTube, and then LinkedIn, just Michael Bjorn Huseby, my name.
Awesome. Well, yeah, if you're interested in real estate, even if you're interested in investing in it, if you're interested in starting your own fund, I highly recommend giving him a follow. He has been awesome. He's very responsive. He's also a great cheerleader when you're out there running and training, trying to do Ironman, triathlons, whatever you want to do. So, Michael, thank you so much for coming on the show, and we will talk soon.
All right. Thanks, man. Thanks for having me on.